So good morning to you all. Just a few more seconds and we get started. We'll go through the introductions anyway, so if people join along the way, that will be fine. Welcome to this fourth webinar of this year. This webinar is dedicated to developing your own advanced fraud indicators. So for this agenda, this webinar, a very short introduction about myself and Sepia Solutions, and very short is a keyword. An overview of the webinars, past and future, and then why do I use Arbutus Analytics? Why would you perhaps want to use it? We'll see. And then the business case. It's fictional data, but it's a business case that I think leans towards the practical and the possible. A very short overview of last week's webinar, because last week we did basic fraud indicators, whereas this week we'll focus on more advanced fraud indicators. And then the most the most of the webinar, very practical, is how to implement them. So I will illustrate all of the indicators and also the report at the end. One more slide on the next possible steps if you want to continue with data analysis like this, and of course a Q&A session at the end. So about myself, my name is Alain Rousseau. I started Sepia Solutions in 2010 already, and simply I love doing data analysis and working with the tools that we do. Sepia Solutions distributes two tools in the GRC area. The first is Arbutus Analyzer, which is the tool we'll be using today, and also IT Agent's Pentana Audit. Technically, we're very far ahead, and I mainly love doing the implementations of projects at clients and training. This year, I've hosted 4 webinars in May, one illustrating how to expand your own data analysis toolkit. In September, with co-host Neil MacDonald, we looked at continuous assurance with data analysis. And just last week, in the run-up to this week's event, is developing your own basic fraud indicators. And in light of the ACFE's Fraud Awareness Week, so this webinar is focused on more advanced fraud indicators. Why do I use Arbutus Analytics as a tool? This is not a commercial webinar, but I do want to explain why. Not only I use the tool, but why Sepia Solutions distributes the tool. Analyzer Plus is basically a very good toolkit, a very good software tool to basically get to a lot of data files and not be limited to any type of data or any data size. So again, there's no limit to the size you're working on, and it includes an automatic audit trail with all the commands you execute. There's more than 100 to 200 commands and functions combined, solely focusing on data analysis. Okay. There are more components there in this architecture. There's a lot of data connectors for various applications and databases. And through the hub, which is a server component, you can schedule these analyses so that they become nearly continuous or nearly real time. There are additional components such as Results Manager and Web Connect to process the, let's say, output or exceptions, but I won't go into that, nor shall I discuss the mainframe server. But I will discuss one more thing, which is the ecosystem in which we live. Arbutus Analyzer is created in Canada by Arbutus Software Incorporated, but there's a lot of partners worldwide, partners like Sepia Solutions, who distribute the tool and add additional value through webinars, through local events, through support groups, and so on. So you're not alone out there. If you have questions regarding this tool, you should find the resources. If not, look at the website later on. You'll find a menu option there with resources for data analysis. For this webinar, I shall only use Analyzer Plus, which is the main desktop component. So realize there's more out there, but this is what we use for now. Now to the business case. We're working with a large data set, or you might be working with a large data set, maybe thousands, maybe millions of transactions. It could be sales, purchasing, cash expenses, invoices, whatever you have. Could even be firewall logs or other type of logs. Now, the data set that I created for today, and I do mean created out of thin air, includes a transaction ID. Perhaps it could be an invoice number. It includes a timestamp, date and time that is, an amount, so the monetary value, and an identity. I didn't want to call it client or vendor or employee because the identity could be anything, and that depends on your process. And the goal is to review the transactions, create kind of a risk score or fraud indicator, a focus indicator, or a weight, whatever you like to call it. But rather than, let's say, investigating all these millions of transactions or creating a sample, which I call a dumb sample because it's just good or bad luck to find some transaction out there that's interesting for further analysis. So rather than sampling, I would like to use these risk indicators or fraud indicators to see which transactions would be most, let's say, deserving of further analysis. Now let's already now get to the software tool just to look at the data set we have. I need to start it up. Right, so this is Arbutus Analyzer that I'll be working with today. Now, if you have another tool, yeah, that's fine. If it's a data analysis tool, you should also be able to do what I do, maybe not during the webinar, but afterwards, or at least use the ideas here for these fraud indicators. So this is the table. It's called transactions. And as I mentioned on the slide, I have a transaction ID. I have a timestamp with date and time. I also have an identity. Again, it could be the invoice number, could be the vendor number, an employee number, or anything like that, and an amount. And again, if you are not seeing a data analysis tool or the columns I'm talking about, please let me know in the chat. Now, as for the tool itself, so at the top we have a menu item and a lot of icons here in the toolbar. One of them I'll just click here, the count. So let's just count the number of records in this data set. So if I approximate, it's 2.5 million, 2.5 million records. That's the data I have and I'll be working with today. So already a disclaimer or a warning. Yeah, this is a live demonstration, so chances are something will go wrong. But also I am indeed working with over 2 million records. So it will take time, more time than in most of the demos you'll see out there who will work with a couple of hundreds or at most a couple of thousand records. So take that into account that some of the analysis may take 1 minute, 2 minutes, 3 minutes or more to complete. But again, we are working with millions of transactions. Okay, that's the warning. Last week, we looked at, I call them simple indicators because they were only working on one single transaction each time. So if every single transaction was evaluated against these parameters, random amounts, was it a very random amount? Was it a zero amount transaction? Was the amount just below a threshold that might require additional approval or a 4i review or some additional process within your organization? We identified also transactions that occurred during the weekend. We looked at transactions outside working hours like 3 a.m., 3 o'clock in the morning, and transactions on holidays or public holidays. Now, of course, all of these were aimed to identify anomalies within the transactions, but that requires you to know what is normal for yourself. What is a normal transaction for you? It is not normal that somebody is entering invoices at 3 o'clock in the morning, but it is quite normal for a web shop to process incoming orders at 3 o'clock in the morning. They operate 24 hours a day. So depending on the process, some of these parameters may have more value than others. I do realize that. as do public holidays. The public holidays depend on your region for one thing. So take that into account that first of all, you would need to know what is a normal behavior in your processes to identify what are the high risk or anomalies within that. I will not go through all of these today, although I will be using them again later to have a total that includes these scores as well. So for this webinar, we will be looking at fraud indicators or focus indicators, risks indicators, if you want, that look at multiple transactions for each. And the first one is actually by request. Last week, somebody did make the request, could we look also at missing transactions? It wasn't on my list, but it's actually so easy to do, so I'll include it anyway. Also, we look at duplicates. For this exercise today, we'll look at exact duplicates, although we can also do fuzzy duplicates. We look at outliers by amount. We look at infrequent business partners, often like one-time vendors. We look at transactions that for each identity, again, whether that's a vendor or a client or an employee. So for each identity is always the same amount. Maybe normal, maybe not, depending. And also for each identity again, whether the amount on the transaction only increases and never decreases. So those are the indicators for today. So the first one, how do you actually start doing analysis on missing transactions? Well, as illustrated, this is just a list of, let's say, identifiers, and some of them are missing. So if we go to the tool itself, here we are, we have the transaction ID. And in this data set, some are missing. Now, you won't go eyeballing and scrolling through all these millions, not even thousands of records, and hope to identify one, let alone all of them. So what we do is we simply run the gaps command. The gaps command, based on one of these fields that we have in a data set, transaction ID. I do not need to pre-sort this table because I know that this table is already sorted by the transaction ID. And I want to list all the missing items. Now, list ranges is basically the same thing, but then rather than listing every missing transaction ID individually, it will say I'm missing from 3 to 8, for example. Let's go with the output to a new table, which I will call FI for focus indicator or fraud indicator 07, because it's my 7th indicator after last week, missing transactions. Okay, here we go. So again, it's looking at 2.5 million records, which is taking just a second there, actually quite fast still. And this is the output. I have 8 transactions, 8 transaction IDs that I do not encounter within the range of this data set. I can't show you more. I can't give you details because they're not there, of course. So this is one of those exception lists that I would, in that case, go back to whoever is the data provider and ask, where are those transactions? What is the reason for them not being there? Yeah. If they are there, it's just further analysis on your part as to how far you can dig. The only thing we can show here is that in this complete data set of over 2 million records, those 8 are missing. That's all we can say based on the data that we have. So it's a very short test, a very short illustration, because that's exactly what we do. We look for missing items with this gap analysis. And just for your information, everything we do within Analyzer is logged here in this tab called Command Log. So this is what we did. We opened the transactions at the start of this live session. I counted the number of records, which was 2.5 million. And then I did the gaps command to this new table. So everything you do is logged. And I have already prepared this, obviously, and copied all the commands that I'm doing live now and copied them into a procedure so that I can re-execute the same analysis later again, which I will do by the end of the session. So we're looking again at the transactions. We can, apart from the gaps, also look for duplicates. And if we do a duplicate check on the transaction ID to the screen rather than a new table, let's see what happens. Oh, I left the pre-sort on, but there we go. There were no duplicates detected. So based on the transaction ID, there are no duplicates. So data-wise, it seems clean as it was. However, we can also do a duplicate on more than just the one field, such as the timestamp, the identity, and the amount, basically all three fields apart from the transaction ID. And this is just a exact duplicate. As you can see here, we have options to go for a near duplicate or similar duplicate. But for now, I'll just look at those. And if it is a real duplicate, then I do want to include the transaction ID, because later I want to link that output back to my source data. I'm going to do that to a new table called FI08 for fraud indicator 8 duplicate transactions. Okay, there we go. Again, yeah, preset needs to be on in this case. So again, it may take a second there. Oh, where did that go? Oh, there's back. So here it's the new table with duplicates, quite a number of duplicates. If you can see, if I just count it to make it more clear, 165,193 duplicates. Whether or not this is normal, again, that depends on your process, on the type of data. So this is a new table, as you can see, FI08 duplicate transactions, and I created that based on the transactions table. And now I want to use that second table to create this fraud indicator. So the first thing to do then, in this case, I'll be using a relation. We can also join tables, but for now I want to use a relation. So this is my parent table, transactions, and I want to link that to the one I just created, the duplicate transactions. And this is why I wanted the transaction ID in the output as well, so I can link them. There we are. So these tables are now linked. So how can I now identify the duplicates from this transaction table? Well, I'm going to create a new field. Like last week, we had a lot of repetition in that respect. So FI08, fraud indicator 8. Just repeat that here, FI08. Duplicate transaction. This is just for the view. And just like last week, all these indicators all have a default value of 0. So if everything is normal, no anomalies, the value, the score, the weight, the risk factor is 0. However, if, and this is a condition, if I find that I have this transaction in this second table, which I related, and I can see here the related table, so I'm getting to the other table. If I have a transaction ID in that related table, then I know it's a duplicate. So if this is not empty and there's a logical function for that, so here's the list of the functions here. It's a logical function is blank. So if this transaction ID is blank, means there's no duplicate. So if I negate it by saying not, if it's not blank, then what? Well, then I wanted to have a risk factor, fraud factor of 2, focus indicator of 2. Okay, so this is a what we call conditional computed field. I'm not changing the data source, but I am creating some rules, some logic in there. And then I can add this newly created field to the view. There we are. again, like last week, we can create a trigger. What does a trigger do? Well, a trigger will help us identify visually where these anomalies are. I just call it yellow and say that if this indicator is larger than 0, thereby if we have a duplicate, then I want that cell to be indicated in yellow. There we are. I may need to scroll down a bit. Oh, here we have one, for example. So here we have a duplicate. Now I could, of course, right click and say we filter on this too, because that means I'm seeing all the duplicates. And as you can see here, there are a couple of records in between or a couple of transaction IDs in between, but this is an exact duplicate of each other. The data won't tell me why. That's then for us to further analyze. This is just one of the many indicators that we'll be using today. Here we are. So that's the duplicates test already. Do hold me if I go too fast. The 9th indicator, or third one for today, is an outlier based on the amount. The amount here is a monetary value. I won't do the outliers on the whole data set because it has data from many different, maybe vendors or clients. So it would be too vague, let's say. Just compare it to yourself. If you buy lunch, yeah, if it's just a sandwich or something, it might be anywhere from 3 to 10 euros. But if you eat out or have dinner, it will range from anywhere between, I don't know, 10 to 150 euros for one person, for example. Or if you buy a new laptop, it would be anywhere from a couple of hundreds to a couple of thousand. So depending on what you buy, the distribution of those amounts will be different. That's why, first of all, I want to have these statistics there per identity to try to see that I match the same things together. Now, what about this outlier? As you can see on the slide, and this is not the best exact illustration, but it's just that, an illustration. If normally all these white dots signify the events, the transactions, the amounts for that particular identity, you would have a peak in, let's say, chance or frequency of it occurring on the average. So the peak would be the average of all the transactions. And then the further away we get from the peak, the less likely it is that the transaction would be that amount. And that's what I try to illustrate here with the amber or the red dot, is that that dot is so far away from the peak that it is very unlikely. And that is exactly what we want to capture. And I'll leave the more scientific explanation to the statisticians among us, or amongst yourselves maybe. So basically what I want to know is, I want to know where the peak is, the average, and I want to know how far away every transaction is from that peak and how far away is measured in standard deviations. So the more standard deviations, or the more miles or the more kilometers you might say it is from the norm, the more unlikely it is, and therefore the more strange it is. And that's what I want to capture. So this is a two-part operation. First of all, I'll need to create those statistics for each identity. So back to the tool. Based on the identity, I need to summarize the data. So I'm going to use the identity as the key, and I am going to use the amount field not once but twice, because I need to calculate the average and I need to calculate the standard deviation. And I'm a bit backward that way, but I want it to be called SDD. So I want the two fields that I'm creating to be called amount AVG for average, amount standard deviation. This needs to go to a new table. I'm going to call it temp because it's basically a temporary table. That's per identity. Anything else I need to do? No, I think that's fine. Yep, there we go. So it's doing the calculations. Do I want to save the changes? Yeah, that's fine. And this is my new output table. So for each identity here, let's just see how many there are. 6,306. So there are 6,306 parties, again, employees, vendors, or clients, whatever they may be. And I have computed, or rather I have analyzer, have me computed the count, so the number of transactions for each of those identities within my dataset, the average of those amounts, and the standard deviation. So what this is telling me is that, for example, this identity, for which I have 23 transactions, the average is about 97 euros with a standard deviation of 2. So it's a really narrow bell shape or Gauss curve, if you like, which means that if I would then have a transaction of even 120 euros, it's far beyond a number of standard deviations. So these are the statistics that I need. And then I go back to my transactions table and I need to link that data again together. How do I do that? Just as before, I create a new relation between this transaction table and the newly created one, the temp stats per identity. Just make it a bit more visible. So I can link the identity to the identity there in the stats table. And we finish. You don't see anything because just creating the link, it's not doing anything else. Then I can use that information to again create a new focus or fraud indicator. In this case, I'm going to call it FI9. And the default value is again 0. FI09 is outlier on amount. What are the conditions? Well, if what? We're looking at the distance, and the distance measured in these standard deviations could be equal to amount minus the average that we just calculated here, and that's in this other table. This is the average right there. So we are doing that amount minus the average, and we divide that by the calculated standard deviation to see how many, in quotes, air quotes, miles away are we from the norm. If that is more than 6 times, and statistically this is very, very unlikely, but this is strange data as I created it, then I want to have a value of, let's say, 6. And this is an arbitrary value that you can decide on depending again on your situation. I can copy that condition. I'll create 2 copies. So I can update this one and say, if it's not 6 miles away, as it were, 6 standard deviations, but 4, then I want a risk score or indicator of 4. And if it's just more than 2 standard deviations away, not 12, 2, then I want the score to be 2 quite easily. And again, you can tweak that according to your own rules. Okay, there we are. And we close this. And now I can add that as well to my view. So here we have that new focus indicator. And just like before, I'm going to create a trigger. People who watched this last week will say, yeah, I know about that. That's fine. That's good. Repetition is key to learning. So if that focus indicator is above 0, then I want it to turn yellow. Done. OK. Oh, I've got one here at the end of the table, at the end of the view. So here I have a indicator of 2. Now, to visually or rationalize that, I'll just add temporarily these other fields to the view as well. So I want to see the count, average, and standard deviation. And that will help us see what's going on. So if I just filter on this one identity, I can see that for this one identity, we have an average of 1,039 euros or dollars or whatever the currency may be. I have 38,000 and the more transactions. So there's a lot of data there. So the more data you have, the more, let's say, accurate this analysis would be, and a standard deviation of 1,600. So if I'm looking at a value of 5,000, just 5,000 minus the average, and I'm approximating here, would be 4,000. So the distance is 4,000 divided by 1,600. So one standard deviation is 1,600. Two standard deviations is 3,200. Yeah. So 4,000 in distance is more than 3,200, and therefore it's more than 2 standard deviations away, and therefore it gets a score of 2. Okay, so that's basically the rationale behind it, and that's why seeing those additional fields there for a moment is helpful. Okay, so that's hopefully, broadly speaking, the how you could see the anomalies there, the outliers on amount. If there are questions, please let me know. Otherwise, we'll continue with the next one. And the next one, luckily, is now far easier. So this is the one-time buyer, the one-time vendor, which transaction has an identity that appears only once. And this is now very easy. Why? We did all the hard work just before. Just before we created these statistics per identity. So if I now go back to this data set, I'll just clear that and say any transaction where the count for that identity equals 1, that's a one-time buyer or a one-time vendor or whatever the one-time might be. So if I would say, okay, I want to filter on count equal to 1, let's see, then we have quite a few still. So all of these identities appear only once in this data set. So this is how we, again, will create this new field. Quite easy now. Again, we go back to the table layout and we create focus indicator 10. And it's called infrequent, whatever it may be. And again, the default score is 0. There are many ways to write this next logical statement, but basically you can say when the count equals 1. We won't have a count equaling 0 because that doesn't exist in the data set. Or you could say where it is smaller than 2, exactly the same thing, and so on. So I'm just doing the one rule here, the one trigger. If it's equal to 1, and that's probably the most clear, if it's equal to 1, then I want the value, the risk, to be 4. Why 4? Because I said so. There we go. Yes, and we add again, I'll put it here, add that column to the view. And again, we create a trigger. If that is larger than 0, then I want it to turn yellow. It's going to be my mantra. If it's larger than 0, I want it to turn yellow. Right. And of course, here they are all yellow because that's still the filter I have on. So if I clear the filter, you could visually see where those one-time transactions occur. Oh, here was one just before. Here was one. Okay. So that was dead easy because again, we did the hard work of the summarize and relation for test number 9. What about this then? What about an identity, again, a vendor or client, that has transactions for always exactly the same amount? Now, I'm not sure how things work in other places of the world, but right here locally, we quite often have, for example, the electricity bill, which is the same throughout the year, at least 11 months out of the year. It's the exact same amount, and in the 12th month of the year, they do the actual calculations of how much you consumed in terms of energy, and then either you pay more or less depending on what you paid already in the year. Yeah, just one example. So it's quite normal in that case to have 11 exactly the same transactions and just the 12 being different. if you're leasing a car, renting an apartment or whatever, it's quite logical to always have a lot of the same transactions, and after a while it changes. So again, whether this test is valuable depends on your data. So how can we test that? Again, this is actually very easy, because in this illustration here, these orange dots, the average would be one exact amount, and there would be no standard deviation because all these values are exactly the same. And that's it. That's exactly what we need. So if this standard deviation is 0, like in this case, quick filter equal, that means that all the transactions are the same. Now, of course, if I only have one transaction, of course, it will be the same. So I need to filter those out where it is not equal to 1. So here we have a few. So here we have an identity with 53 transactions, all of exactly the same amount because the standard deviation is 0. Or rather, the standard deviation is 0 because they're all exactly the same amount. So I will clear the filter, and we'll use that logic again in a new focus indicator. Always the same amount. And again, the default value is 0. Now, how about the logic? So the logic is that the linked standard deviation is 0. That means there is no deviation. But of course, we want to make sure that maybe the amount itself is larger than 0 if there are vendors which are always issuing a 0 amount transaction. That's strange in itself, I agree. Something to look at. And the count is, let's say, larger than 20, meaning if I have more than 20 transactions for this identity and all 20 or more are exactly the same amount, i.e. standard deviation is 0, I find that very strange and I want to report this anomaly with a score of 6. I'm creating 2 more copies. So maybe I don't want to look at more than 20 transactions, but more than 10. If so, I'll give it a score of 4. And if I have more than 5 transactions of exactly the same amount, I'll give it a score of 2. And you need to tweak this to something that is logical for your situation. Yes, please. And then I can add that new field to the view as well. And so on. I'll leave that yellow for once. Yeah. So this is how we can catch transactions by one identity to one identity to one bank account, whatever it may be, of always exactly the same amount. And now already the final indicator, but a bit more thinking required. Can we identify identities for which the amount only goes up? Which may be logical again, maybe not, but maybe this is the norm that sometimes you have higher and lower transactions, so they go up and down for this one identity. I just want to find out, are there identities that only have transactions of increasing amounts? Now, I would have defaulted to coding this in a group command, but I thought for this webinar, let's try to find an approach that does work without any coding whatsoever. And I found that. So first of all, I am going to sort the dataset by identity, leaving the amounts in whatever order they are. Then I'm going to check that newly created table that I did with the sort and see whether there are sequence errors, as we call them, on the amount, meaning that the amount goes down for that particular entity or identity. Okay, and if it goes down, if there is such an error, again in air quotes, that means that for that identity, the transactions go up and down, which is what I, in this case, would expect. Okay, so this is what we'll be doing. Go back. And in the transactions table, I want to sort the table based on the identity. I'm going to create a new table, call it temp sorted on identity. So identity. I can open the table just to show you what the output is. If some of you have done this, you might argue, do you need to also order it by timestamp, yes or no? In this case, I decided not to. That's end of discussion. So here we have the sorted table. It's sorted by identity and then leaving the other fields or records the way they were. Now, we can then do a sequence check. So basically verify whether the table is ordered by identity. I know that because I did that. I sorted the table by identity, so I'm 100% sure that's the case. But I'm not so sure about the amount. So let's see what happens. I'm going to screen for explaining purposes. So what this is saying is, for this identity here, I have errors on record 2, 5, and 8. Let me show you here in the table. I have errors on 2, and what is an error? Meaning the amount is going down. That is what I'm doing. I am checking the sequence of the amount. I see the amount go down on record 2. I think on record 5, again, from this value to that value, it goes down. And again, on record 8, from that value to that value, it goes down. So this is what I have. I'm going to do that command again. So I want to check that based on the identity and the amount. I am going to a new table now because I need that table to work with and to relate to. Call it temp sorted errors. The error is, well, maybe a strange word, but I just use that. So you could say sorted on sequence up and down, for example. And I don't want to stay with the 220, let's say, errors as a default, but 2 million. Yeah. So I'm going to create that table. This is it. This is the table that includes, basically, if you think about it, this includes the identity, possibly more than once, but the identity of all those parties for which I have transactions that go up and down. So you might say these are the good guys. To make it very, very simple, this is what I expect. These are the good guys. So if an identity does not appear in this list, that means that the amount for that identity throughout the transactions only goes up. Yeah, so it's a bit of a twisted thinking, maybe, but there we are. This is now yet another table I need to relate to the source, sequence errors. So again, I link it based on the identity. Finish. And I can create my final fraud indicator for today, through the table layout. So this would be FI12. Again, with the default value of 0. And remember, this is a bit of a twisted way of thinking, but anyway. So if I do not find that identity in the other table, which other table? The sequence header. So if I don't find it, that identity is blank, and we can check for that with the isBlank function. So isBlank of that identity means it only goes up. And if it always stays the same, it would also not be an error. So we want to take that out. So and based on that other one per identity, the standard deviation is larger than 0, meaning there is some variation in the amounts. And the number of transactions is larger than, again, a limit that I pull off thin air, more than 20. Then I want to have a risk score of 6 like before. And just like before, I create 2 more copies. Just reduce this limit from 20 to 10, make it a score of 4. And here from 20 to 10, maybe more than 5, and give it a score of 2. All right, there we are. And then I can add this to the view as well. Okay. Finally, I want to total all these indicators, and I'll get back to this in a moment. I want to total all of these. So I'm going to create one more indicator, fi total. And I would say this is a sum of all the ones I created before, like 8 plus 9 plus 10. No, not plus, that's it. I'm a bit quicker here because I want to redo this anyway. And then I can add this newly created total to the view as well. There we are. Yeah. And then I can work with that. Now, I have, as I mentioned, created this procedure, and it will do the fraud indicators of last week. It will do, again, the indicators of this week and create a nice report. And this will take 3 to 4 minutes. And I don't have a problem with that. I'll let it work. And in the meantime, we can just review what we did. So I'm going to go back to the slides. Yeah. So what we're doing, what the script is now doing, is nothing else than what I've done manually. So I'm not doing anything in that procedure that I did not do manually just now. It just groups it all together. It groups it together. So also last week's transactions are included. And I'm going to jump back there to the slides a bit to have the overview again. So last week, we included round amounts, so a number of zeros at the end. We included zero amounts because that is also an anomaly of its or in its own right. Excuse me. We looked at amounts near thresholds, trying to illustrate that for some things people might be ducking the threshold, ducking the review and approval process. We've looked at transactions during the weekends. We looked at transactions outside of working hours and transactions on public holidays. And for all of those last week, we created that risk score that we're also creating today. Okay. Today, we have looked at the missing transactions, and be aware this is not one element that is included in the report that is being generated at this moment, because they're not there, basically. We have looked at duplicates based on multiple fields. We have looked at duplicates based on the amount for each group, let's say each identity. We have been using the standard deviation and the average, and I realize that for some this is maybe a bit new, that approach, so we'll see. Infrequent business partners, as we did the statistics per identity before, and we created the relation or the link between the tables, that was quite easy to do. And then also always the same amount per identity. Again, we used the standard deviation that we calculated for number 9. And then finally, the one with the twisted logic. So if there were no sequence errors, the amount was always increasing and so on. So these are the 12 indicators that we have. Number 7, again, won't be in the report because the data is not in the report. And by now, we will see how far the analysis has proceeded. So let's just get to the correct slide again. So nearly finished. Again, I told you it's 2 to 3 minutes. I don't have a problem with that. Again, it's looking at over 2 million records just on this silly little laptop of mine. So if you see another demonstration or something like that, do take into account this is, let's say, a realistic data size to work with. But we're nearly done, as I see. There we are. And it's creating this nice view with all the yellow colors, again, as I did manually. It's popping up with a message saying that out of the 2.5 million transactions, we identified 218 as high risk. Again, based on the profile, which is the threshold that you set. So I did all these calculations. I made rules if it occurs more than 20 times, if it occurs more than 5 times, and so on. These are rules that you decide. And also, what is the cutoff point? So if you have that total in the transactions, what is the cutoff point? And I think I'd taken 9 or 10 to then come to the 218 most interesting transactions to look at. But it warns me, don't overlook the missing transactions. That's a separate test. Yeah. So here we are, and we could, for example, just sort this based on the transaction amount to have a look at these rather high amounts, the high risk scores, and we can see why it scored so high because all of these different transaction analysis. So again, 1 to 6 were based on the single transaction, and 8 and above were based on multiple transactions for that identity. That's it in terms of practical implementation for these analysis, these indicators. If you're interested, how can we continue helping? Well, first would be a meeting to explore your situation, requirements and objectives, then a workshop, maybe online, maybe physically, depending on the situation. And afterwards, maybe a full implementation of Analyzer and all its data access and so on. So you'll see these are the options, it's up to you. Do you have questions? By way of recap, we had a short introduction, we had an overview of webinars, we looked at the business case, the simple or basic fraud indicators of last week, the more advanced fraud indicators today. And don't forget my question, I only had one suggestion so far for new topics next year, challenges, topics, something for next year. So feel free to, in the chat, post your question right now, or to make your suggestion for something next year. Do I have any? Pretty silent. I'm not sure whether there's still anyone here. Or did I bore you all to sleep? Could be. In that case, I hope it was a restful hour. Somebody mentioned artificial intelligence. That's a very nice topic. I've been thinking about that for next year, but I always say don't run until you can walk. So if you have not done serious data analysis at all, yeah, I wouldn't start with saying to the black box called the artificial intelligence, please analyze my data. You need to know your own data. You need to know your own process, whatever artificial, whatever is out there. So I'm not against AI, not at all. But again, walk before you run, analyze your processes, analyze your data so that you have an idea of what is going on. Rule-based, as we did today, before thinking about AI. So that's just my 1 minute, let's say, feedback on AI. But there will be more to say, and it may be a very good topic for next year. I'll take it into consideration. So thank you again for your presence. I do still hope that I get more suggestions by email. But I'll let you go now. Thank you so much, and I hope to see you again in a webinar. Thank you. Goodbye.